how is that going to affect buyers coming in? Because now they've got an additional cost that they hadn't worked out, that they didn't have to think about before. Well, they may or may not have this cost, of course, depending on who's listing the home. And how are mortgage providers handling it? What's the future look like?
Sure. This is probably the most fascinating question in a boring industry, so to speak, that we've had for a long time. And yes, you explained it. I'll probably make it a little more tactical for any of those first-time home buyers or people that are listening, that generally it is the seller that pays what was traditionally 6%, 3% commission to the seller's agent and 3% commission to the buyer's agent. And that was kind of a tradition. It wasn't a law, it wasn't a rule. It just became a tradition in the industry. And for the first time now, that 3% and 3%, total of 6%, which of course in recent times, especially California, has been negotiated down to more of probably a 5% has probably become more of a standard, if you ask me, 2.5 and 2.5. Well, still, regardless, one of those halves is now going to be shifted onto the buyer side potentially. And in California, if you're buying $1 million home, that's 2.5, 3%, that's $25,000, $30,000.
Yeah.
Well, those are extra costs that have to be put somewhere. It could either be actual closing costs where a buyer is coming in with an extra check of $25,000 to $30,000 at close of escrow. I think that's going to be a hard apple for people to take a bite out of, especially in the transitionally, because for generations it hasn't been that way. So the buyers are going to be like, wow, instead of the standard $10,000 of closing costs between appraisal, bank fees, title and escrow fees, etc., now that number has gone from 10 to 40,000. Well, is that extra savings now? Where is that savings going to come from? So to answer that, the industry has to come up where this is going to be paid from. Is it going to be paid from concessions from lenders, for example? Will buyers that are well qualified say, well, can I take a higher interest rate and get a credit on the loan to pay for some or all of this? This comes to the crux of the question, is who can pay what? And the answers come from a very, very written in concrete stone, well-established set of guidelines and rules, mainly dictated by Fannie Mae and Freddie Mac. These are quasi-governmental organizations that set the guidelines for 95%, I'm making up that number, of all of the loans that get closed in the United States. And they're the ones setting the minimum credit score guidelines, the minimum down payment guidelines, where you can work, how long you worked, etc. And some of these actually are specific guidelines about what are called interested party contributions, IPC. And they set maximums so that you can't come into a transaction and that a deal can be thrown way out of whack by a real estate agent throwing in all of their concessions or commissions to a buyer to make something happen. There's maximums that can be for all of these interested party contributions that can be thrown into the pot. And these guidelines are very strict and written into even what's called the secondary market, which is the buying and selling of loans. So when Fannie Mae and Freddie Mac say to us, CMG Home Loans as a mortgage bank, if you provide us a loan that fits in this box of guidelines, we will buy it from you. So that creates liquidity in the market so we can go out and sell more and people can keep buying homes. That process of secondary market liquidity is key to making everything running. Well, that machine has very strict rules about what kind of loans that can go into it. And these interested party contributions would mess with what can go into those pools without very old and rigid guidelines being changed. So it's in flux. Nobody knows the answer. If anyone says they do, they're making it up for the moment. But to make a very long and complicated story short, we don't know. And I think the industry right now is trying to come up with solutions for those buyers that are going to be forced to have $10,000, $20,000, $30,000, $40,000 extra of expenses that they just don't know how to cover if the seller is not going to cover it.
And that's very important, that word if, because a lot of cases, the seller will continue to pay them. So it's not something that most buyers are going to have to worry about, but it is something to be aware of when you are buying a home. And I also want to just circle back to the point where you said that it's very much undecided and that the rules are very strict around it. So if someone's telling you, don't worry about it, we'll work that into the mortgage, you're saying it's not that
Right. There
straightforward.
is no one has the power to say, don't worry about it, we'll work that into the mortgage with confidence. That is likely. Everybody wants this to work. No one's stopping and saying, hey, we want to halt the whole process of this entire buying and selling. The US government wants more homeowners, period. End of story. They will make a way and find a way to give everyone the leverage that is needed to come up with a solution. But this might not happen in month one. This is a very large, slow turning ship. In my opinion, this could take years, plural, to actually trickle down to make changes into our industry.
I actually totally agree with
That's
you.
just an unsupported opinion for the
No,
masses.
no,
But yeah.
I actually think that's very sound opinion because nothing happens just like this. A light bulb goes on and everything changes. It also takes people being educated about the
Right.
change to trickle down, because this is not going to be something that is like obvious to everybody. Do you